How are you? Well,
I'm good. How are you?
yeah. Where are you, in London or?
Well, Hertfordshire, sort of Boreham
Very
Wood.
good.
Yeah.
Very good. Good. We've got a couple of clients in Bishop Stortford there. So.
Oh, lovely.
Out in that country, they're very nice places. How you finding things? Good. Generally okay?
Yeah, it was a bit. I was a bit worried at the first when everything started kicking off, but then work-wise, it's just been manic. I guess because my patch is like business and personal finances, so
yeah,
it's just crazy at the moment.
Great. That was the word I was going to use. Crazy. We were just on with some guys, and I said I don't think they understand how much is actually unfortunately going to come through here. It's going to be a fair wave of stuff. Fair wave.
Yeah.
So, but we'll see how it pans out. Hopefully, it's not as bad as the depression. I'm going to take a hit. It's just relative to where it is. But it's just the day-to-day sort of news feed is a bit debilitating, isn't it? To say the least.
Exactly.
And do you work freelance, Mark? Are you freelance?
Yes.
Or are you...
Yeah. So yeah, that was the main worry, that all my kind of regular stuff would stop. But if anything, you need having actual news at the moment is more important than ever to combat all the fake news stuff. So
there's plenty of that, isn't there?
There's a lot of fake news.
And there's the terrible thing we're doing as well with the mental health backdrop is how we're managing to talk ourselves into these issues. And there was something the other day. If you could just get rid of it. But they didn't say just get rid of it. It's actually a lot stronger language. If they could just all go away, just for a week, it would be a different place. I'm a gentleman of a certain age, and I've not long been on Twitter, but I can't believe the vitriol and the nastiness. It's phenomenal. If you were in a bar having a drink, you wouldn't sort of stroll at someone and say you're a tramp. You'd end up in trouble. But it seems to just get royally abused. So, what other publications do you work on, Mark?
So I do peer-to-peer finance news. I do some stuff for an estate agent trade website called Property Industry Eye.
Right.
And then just generally pitching into the Times and Mail.
Very good.
Business Insider, I do quite a bit for.
Very good.
A good mix. With what does Bell & Company do?
Okay, we work under the title of rather grand title of debt strategist, but it's what we do. So essentially, we find every case is different. There are different precedents and methods that you can use in cases, but every case is different. So we develop a strategy specific to that client's requirements or issues, and then we implement it. And we'll work from bankruptcy through to multi-million-pound debt. And we set ourselves up in Northern Ireland on the back of the last crash, totally in a haphazard way, but we developed now where we've got a team where we work on European properties, any debt essentially. There's a group of 22 employees, and main base is Belfast, office in Leeds, and an outpost in Spain. That's essentially us in a nutshell. Any debt.
So you're working on the borrower side rather than the person chasing the debt.
Absolutely, yeah, absolutely. We do get on with. So, for instance, in Spain at the minute, we've been asked to help a couple of the major banks there. They've still got the legacy debt of 2008 crash when the negative equity was huge and massive mis-selling. Same in Cyprus, but with two banks we work with there. But that's purely on a bit of an advisory thing, just to get their heads on how it works here in the UK. But yeah, on the side of the debtor as opposed to the creditor.
What's the sort of regulation on this side of thing? What do you need to be able to set up as a debt strategist?
Well, we're FCA regulated. That's our requirement there. And then other than that, we're between a couple of stools. So by trade, I'm an accountant. Okay, I'm a very good accountant. This is what I specialise in the strategy there, doing that. Then we need legal input very often. We try to avoid litigation if we can. The world's a bit too litigious, and I think it's going to become more and more so, unfortunately, in the short term. But you're trying to avoid that if you can. Sometimes it's necessary, and cases can go on for years, with cases that have taken 8 years to resolve. But we have the stamina to see that through. But essentially, with financial acumen, we're trained in what we do. It is a particular niche that we do. We're not insolvency practitioners. Never before.
So what's the difference between an insolvency practitioner and a debt strategist?
Insolvency practitioners are appointed typically by the court. They're called appointees. Usually when they're looking at liquidations, IVAs, CVAs and the like, there's an element of legals in there, and it's formal statute-led process to get settlements in whatever form they come. They're pretty rigid in their approach. And if you, so for instance, if possibly the biggest IVA company there, if you don't meet their criteria, which are fairly simplistic, they don't want you as a client. It's a lot of it's process-led. Ours is more, we're looking at every facet of somebody's position, not the fact that they may have a property that's gone wrong, they may have credit cards and a tax man. We look at the whole, as it were. Insolvency practitioners have a role for sure, but they're fairly fixed with what they can.
And so tell me a bit about the work you do in the peer-to-peer lending sector.
Well, peer-to-peer sort of coming slowly on stream. Obviously, the market's still fairly young in that sort of sense, maybe sort of 4 or 5 years old. And what we're starting to find now, even before the COVID-19 outbreak, was we're starting to get some people coming onto the radar in terms of peer-to-peer lending. And typically SMEs. Peer-to-peer did the excellent job of filling the gap when all the big four, essentially high street banks, hid after the last crash. They filled a good gap, but obviously as a product, as you call a peer-to-peer lending, whatever form it takes, as that's evolved, then the problems start to come out, and that's where we get involved. Obviously now, unfortunately, with COVID-19, that's going to exacerbate those problems, and that's what we're.
Tell me a bit about the problems that you think have started coming out.
Well, you've got the ability to, obviously, the ability to service any debt within reason. If you if you have the ability to service any debt you've got there, that doesn't become a problem. Obviously, most businesses have faced an incredible crash in terms of their cash flow. The restaurants that are like a real easy sector to look at, and if they haven't got the ability to pay, or were struggling up to that point, because I don't think the economy was that great pre-COVID-19. We've had interest rates as low as they've been, but still the economy is sort of spluttering along, as it were. So it wasn't great, and that's why we were starting to get the inquiries. COVID-19 is going to make that a whole lot worse.
Why do you think the economy wasn't so great before?
I think it was flatline. If you look at the interest rates were record low, inflation was where it was. The world was essentially awash with cash, but it still could. I don't think it ever properly recovered from the 2008 crash. And that's unfortunately been proven. There've been certain industries have done well, etc. But there was still a hell of a. I use the word a legacy quite a bit. There's a hell of a legacy from 2008. Even the banks themselves. We deal a lot in Ireland, obviously being based in Belfast. And when you see that Ulster Bank really only last year got their act together, most of the major banks did. Look at the UK banks, as I say, they slightly hit after it. They were the guys throwing the money around trying to get the SMEs going. So the backdrop wasn't good, and I think it's taken, as I said, a long while to recover from that.
Yeah, that is interesting when you think that businesses must be quite vulnerable. I mean, obviously it is tough times, but you must be quite vulnerable if your income is hit and all of, and what am I trying to say? So it seems to be businesses that immediately said they were going to be in trouble, but it just seems weird that you wouldn't be prepared for at least 2 or 3 months of difficulty anyway.
Absolutely. I don't know the stats, but I know it's more than 50%. Most businesses don't have 3 months reserves as such. But then you see how it's hitting industries across the board. So we've spoken to a couple of legal firms, and they're kind of struggling. You think good, steady professions should be okay, but the world's changed amazingly. You've also got the likes. I was listening to Willie Walsh the other night, and he was saying when you've got a cash burn as they have at the moment, 20 million a day, that quickly tops up. Somebody was saying you've got £1.5 million sort of reserves in your last set of accounts. If that's the last set of accounts, 3 months of getting nothing in and a £20 million cash burn quickly gets through it. And every business faces that. There's no the word. I don't like the word journey. I don't like the word unprecedented. But this is just completely new.
So, what sort of trends are you seeing from the peer-to-peer lending sector in terms of, I guess, lending that's been going wrong or the issues that are coming out?
It's the the peer-to-peer have certain criteria to work. So obviously, not teaching you or anybody that's listening to this how it works. But there's set formulas and set platforms. You meet the criteria, the underwriting goes through. That's okay when everything's going swimmingly. There's the reliance in most instances on PGs if required, if it's a limited company or if it's a sole trader or they're exposed. I think the model was starting to struggle because obviously you've got to have the cash inflow from investors or wherever, and so it's coming under pressure across the board. I think there are remedies. I think they need to get to the government and they need to rewrite their books with the governments, because I think that's the government are making, I think, half decent efforts in terms of what they've done with furlough, bibbles and civils, but I think the peer-to-peer market needs a lot of support. And a lot of these loans are maximum 5 years long. Some of them are quite meaty amount. Whereas typically you would have gone to a conventional bank and they'd have been 10, 15 year payment profile.
What specific support do you think peer-to-peer lending needs?
I think they've got to go to the government. I know, for instance, a couple of them have got themselves onto the panels for the Bibbles loans especially.
Yeah.
And I think they need to go there and say, look, we're going to need to do, if you're getting Bibbles loans and you've got a year's grace and you've got a very low interest rate and everything else, that's the sort of thing that's going to help. Obviously, the platforms are writing these loans subject to the risk. So we've seen some rates where it's 18%, we've seen 4 or 5%, which is okay. But 18% sustainable going forward is going to be pretty ugly. And again, it's that large repayment profile with the shorter term loans. So to my mind, only just what I was thinking about the other day, I think the peer-to-peer loans need to appeal to the government, come and help us with our loan book so we can extend this out and make sure this works exactly. Because I think at the moment we're all still coming out the cave and seeing what it's going to be like in the daylight. Yeah. Legal friends are really there to attack everybody. I think it's going to turn pretty ugly at the end of this year, beginning of next year. And peer-to-peer need to take a view here, because it doesn't always get their money back just going legal. It's in that any number of cases that we deal with.
But what are you saying? The government should help peer-to-peer lenders refinance their loan book, or to turn existing loans into C-bills or bounce back loans?
I think they should be looking at that. Yes, definitely. Because if you've got a loan book that works in a certain economy, that's okay. Right? And we were starting to see a couple of things going wrong in there. That's maybe. This is a completely, as you know far better than I, this is a completely different. You can't, going back to BA, when you've got huge organisations have to put their hands up. Yeah, there's a lot, and the SME economy, if you like, basically fuels much of what goes on in terms of the economy, the tax receipts, and everything else. So and there's plenty. It would appear to be plenty of cash. Rishi's got a photocopy on there. He's smashing the cash out.
Yeah.
And I think the peer-to-peer don't want to be too quiet with it. They want to be getting a hand up and saying, guys, we need to support businesses here. Otherwise, it's just going to be carnage up.
Okay. So, what are the key mistakes that you think that you're seeing from peer-to-peer loan due diligence?
A lot of the early cases we're finding, the due diligence wasn't as strong as it should be, and it was nearly that they had the ability to shovel the money out the door, and it was more that they were brokers rather than lenders. And I think that will come back to bite. I think they've got to look at. I think we've got to look at the mix of peer-to-peer lenders as well, because there's any number of lenders there, any number of asset. So there's asset finance, there's tax requirements. I think they need to revisit all of their due diligence and understand it, which is a huge task. But we're getting stuff, especially when there's that massive reliance on personal guarantee. We were with a very well-established, respected accountancy firm, insolvency firm, and they're doing a bit of work on one of the peer-to-peer platforms, and they're saying the due diligence stuff coming through is pretty shocking. It's not too late. Revisit it, but there's got to be the dialogue. One of the questions we may come up with is what advice you would give to a borrower? Get your affairs in order. This is a two-way street. Peer-to-peer lender, get your affairs in order. If you're looking at Bill Smith's asset and liability statement now, now the business has gone down the tubes, don't just rely on the PG. Make sure you do a bit of due diligence. Discount properties, I thought, is going to be a bit of a market there. So they need to go and review some of their own work. But I suggest.
So, I mean, how often are you seeing cases where the borrower ends up not having to repay, or ends up with ends up not being in the wrong, or not defaulting?
Sorry, Mark, what do you mean by that? Sorry.
I mean, I guess that's not really the right question. I mean, what sort of outcomes are you getting for borrowers who are being chased?
It's very early days because they're only coming through into our cycle at the minute. At the moment, it's I think that peer-to-peer, they're going straight to litigation. If you don't adhere to what they want to do, so some firms want their position secured, okay, which sometimes technically isn't correct. I don't think there's necessarily the ability to look in going back to that bit of due diligence, reassessing their position before just steaming into litigation. Not a great lover of the legal profession, but sometimes when they get the grip of the case, the agenda changes, I'll be so bold to say. And suddenly it becomes about they've got carriage of the case, up go the fees, and away we go. So it's I think they need that period of reflection. Not in a, what have you done here, guys? It's more see what you actually have got. We're telling clients, make sure you know what you've got or not got. Make sure you know your financials are up to speed and everything else. And I think the same needs to apply here. They need to go back and check the case a bit more thoroughly. I don't think they would have geared up for issues. They would have had a solicitor in the background. If any cases go wrong, go get them. Not necessarily the best route. Yes.
So, are you seeing an increase in? I mean, I'll ask that in a minute. What about, because a lot of going for forbearance and things. Are you pushing back for payment breaks, or what's the sort of strategy?
Any which way, but each and every lender is different, and they change their criteria quite regularly. Okay, so when the FCA came down on everyone has sort of behaved for a year, right? Okay, we're all okay, we'll calm down. Then suddenly it's going, right, if you don't make a certain level of the payment, we want to charge on your house. That's only going one way. Technically and legally, that may be wrong if there are other creditors, but they're going for that because they're trying to prefer their position. And when it comes to it, and it's making sure they understand the implications of every case, because if they prefer their position and that gets unraveled, it's going to cost them more time, management time, business time, etc., and they may have to repay it. They're not quite thinking that right through.
What do you mean about their position unraveling? Like what's
incorrect? Well, if you go for a charge in a house and it was eventually construed by say that person goes bankrupt or insolvent in whatever form, and then that case is reviewed by a trustee in bankruptcy, they can say, hang on a minute, you did that, you took that course of action because you wanted to prefer your position. Okay, I'm going to unravel that transaction and get us back so that all the creditors get a fair go at whatever asset is on offer. I'll be a little bit harsh and say I'm not sure that these cases are technically thought through what you're trying to get to. That is what we do. We look at the whole. It's very hard if you've got a platform banging the money out and processing it, meeting all the criteria that's set up on whatever the process is. That's great. But now it needs sort of a bit of human interaction in a human view, because it just tearing straight into litigation, which I fear for the next 6 to 12 months will be the case. We'll start getting back into.
At the moment, they can't do that anyway, can they?
No, they can and they can't. Okay, the court process goes on. So the courts are around, by the way. We had an instance the other day where we were trying to do something with the Bulk Centre in Northampton, and the fee can't be paid for 20 days because obviously there's a few people out, but they're going to be inundated. And it's almost, I think there's going to be a bit of a honeymoon period. It's a bit like at the moment, or just prior to Rishi's involvement again, landlords were doing the thing of just finding out statutory demand in terms of rent that wasn't being paid in the last quarter. Obviously, he put a stop to that, but that's a honeymoon period. It's a bit like the furlough. Once it starts coming off, then unfortunately the bad news can start. In a year's time, when the bills aren't going to get paid, the bounce back loads aren't going to get paid, the problems then, when the civils get a bit further down. So unfortunately, it's coming, but it's trying to get yourself positioned right. Both sides of the fence.
So what is your typical advice to borrowers who are getting into trouble with their P2P loans?
We're taking a two-pronged attack. We just developed this since COVID-19. What we're saying is, right, give us, if you like, all of your problems in the new environment, if you like. Then it's a case of making sure. So if you think that business is valid, like I said there, going forward, that's fine. Work out what you can and can't do here. Then come back and we can give you advice accordingly. If your business isn't valid, so say it's a wedding venue, I'd suggest you haven't got any income for at least a year here. But you've got $1 for debt here, so it's then trying to work that out. But I keep going on, and it's not because I'm an accountant by training, but know your position. It's amazing how many people don't know where they are in terms of finances.
Then what are the solutions that you sort of come back with?
It depends on the mix of the thing. We had one the other day. Somebody came to us and they had basically, I think it was 6 or 7 peer-to-peer lenders, different ones. Okay, so if we keep it on theme, and then they had the spectre of HMRC in the background as well. Now, our advice to them, which sounded pretty, there was a lot more to this, but once we got to it, was they had a couple of $100,000 of borrowing, and the man in question had about $100,000 of equity in his home. Our suggestion was you most likely want to consider personal bankruptcy, because then you've only got one problem, not 6, 7, 8 problems. Because you only need one of those 6 or 7 to break the pack and go into full-on litigation, and you're struggling anyway. So it's seeing what the position. You get very often people come and say, I can't go bankrupt. Like, okay, you need about 100,000, you might get through this. And they go, okay, I'll go bankrupt then. And it's just being able to give people that overall perspective in terms of what you do. If you put a price, that's why I'm saying, if you've got your financials right, you put a price on almost, not to be too dramatic, your financial survival. It might be, I'll fall on my sword and take a chance with the trustee here further down the track.
Are you helping create debt repayment plans or anything like that?
Yeah, absolutely. Yeah, we try and work that if it comes to it. And again, we always go to that place first. Again, go back to that thing. If we take away the debt issues and try and find a way through it on each and every element of it. So if it's the revenue, as long as we keep everything up to speed going forward, we could pay a bit off in the background there. You do that. If the peer-to-peers will give us 6 months leeway while the client goes and checks out the validity of their business, absolutely.
Okay.
If it doesn't work, then we're still there, and because that's part of the thing we do. It's not right. That's what we're doing. We're sticking to that. It'll change as we go down the track each and every day.
And how do people know to come to you? Like, how does a borrower find you?
We're pretty strong. There's Nolis in the background, so he's had to get even bigger. We're pretty strong in our marketing in terms of what we do. We're strong in the personal guarantee market, which is our main forte, if you like. That's why we've got a big difference to insolvency practitioners. But we're out there in various forms.
And how do you make money from all this?
Well, we work on a basis typically. First off, what we always do is, and this is the difference between us and insolvency practitioners, we always give independent professional insolvency advice. Insolvency practitioners only have so many products. If we think, so typically we work on a retainer and a success fee on what do we achieve. We'd never take a case on that we wouldn't have a very good chance on. We can never guarantee anything, but we take a view. The bulk of our fee is in the success side. But if we think, for instance, that gentleman the other week, we could have earned more potentially fighting his 6 or 7 creditors over 18 to 12 months and possibly earned more, but in terms of where he was as a person, we suggest that he should definitely consider bankruptcy. We would have earned a lot less. So unfortunately, we're in insolvency, so there's always a retainer payable when we start, because strange enough, if people are in trouble, you need a bit of money off them at the beginning.
Yeah. Is that just is there a typical percentage, or does it just depend on the person?
Massively varies. So sometimes they're fixed fees as well. So when we're dealing with multi-million, so if we're say settling $100,000 debt, we might say, right, okay, it's going to be 10%, whatever we can save. If we're dealing with, so we've got one at the minute in with a bank in Dublin, there it's about 5 million. Obviously, we're not going to charge 5%, 10% on that, because we ain't going to get it.
Okay. And in terms of peer-to-peer lenders, and are they I guess there's two questions. Do you think they have been mis-selling loans? And also, do you think they're treating borrowers fairly afterwards when they're chasing them?
I think there's definitely an element of misstep. Right? Not every case, that's for sure. Not every case, and in fact, a very small minority, because but unfortunately as well, when it's such a frothy market, if you like, standards drop. Certain types of people come in and abuse that. Okay, and that's the client, not the bank or the peer-to-peer lender. And when it gets frothy, they're throwing the money around. In terms of being fair to the client, they should be fair and equitable. They should follow FCA regulation. But that said, sorry, on the other side of it, clients aren't always what they're cracked up to be either. So be fair and equitable. And that's what we'd say. If somebody comes to us and they're worth £1 million, they go, right, I owe 100,000. What do you reckon? Well, we reckon you might want to get your checkbook out and might have 100,000 you owe. If they're in a bad place and there's anomalies, there are issues or whatever, and that wants to be discussed, that's when we typically get it wrong. If the client bangs the rights and they're going down a certain track, we tell them there's no point in hitting any, but debt is, I would say it's not the sexiest subject of the word, but it's become all-consuming if people don't get it right in their head. Yeah. That's not a reference to the mental health situation. Generally, it just always is the case. If you have debt problems, business problems, whatever, that's 24/7.
Yeah. But in terms of loans being inappropriate, is that just because lenders in the past have been too quick to do personal guarantees and just get their money out? Is that what you're saying?
I think there's an element of that, and to be honest, there is quite a soft touch to start with. So I think it was, I don't remember the guy at Barclays. He said, and he obviously he doesn't like peer-to-peer lenders because they take business from them.
Yeah.
But what he did say is that he sees some of these loans are almost like a wonga for business. And there was a weakness on both sides. It was definitely too easy to get it. But come back, if you're being fair, we don't work on any moral compass, right? There's two sides to the story.
Yeah.
Our client shouldn't have borrowed it. Maybe you shouldn't have lent it.
Yeah.
And I don't think they've got that yet. Well, I think it'd be a weakness. Sure.
Do you think the new regulations that have come in have improved things in, well, I guess, since the last year or so? Because that's
very, very much so. Yeah. A lot more stringent lending going on. I think they've started to recognise when as soon as you start thinking any new business when it was flying was great, okay, but and it's a friend once said to me, so he had a personal guarantee, and he said, right, okay, I said, why did you go into that? I said, well, it's a bit like you don't discuss. I said, why did you go into that? Didn't you discuss it wrong? He said, it's a bit like when you go out a first date, you don't discuss divorce. It's a little bit like the business. So peer-to-peer was great, and they did fill a very important gap. Have to say that again when the big four all hit after 2008 crash. But when it starts to go wrong, they have been learning. They have been improving their standards, I think, in terms of the quality of their lending.
I guess if a platform only launched, I don't know, in 2012, even 2015, and if they're 5-year loans, now is when a lot of the problems are going to start coming through.
Yeah, absolutely. But again, with the COVID-19 backdrop, unfortunately, it brings everybody into play.
Okay.
Can I ask you a question?
Yeah.
Have you any idea of not across the board, but the size of loan books involved here in terms of peer-to-peers, what they may have out? Just for context, when you're looking at Rishi for around 62 billion there, and here's 100 billion there.
Well, you've got the bigger ones like Funding Circle and Zopa. They're into the £3 or £4 billion mark, and then also similarly, I guess, Rate Setter are around 3 or 4 billion, and then others are into the hundreds of millions.
But this is where going back to what I was saying about Rishi. So if we go back to the last crash, and it was death by 1,000 cuts with RBS, that was I think that ended up about 70 billion the bill.
Yeah.
Okay, but the untold damage that came from that. So what I was saying about earlier in the context, if Funding Circle was about, say, it's about 5 billion, and the effect of their loan book going wrong for them, obviously, but also for the number of investors in there, and also the borrowers, it's something I think that needs possibly looking at in terms of, I'm not saying, look, this is a great idea. I'm just saying, surely with all the money being chucked around,
yeah,
there's some form of underwriting.
interesting. Okay,
You can have that one free.
thank you. Great. That's probably most of what I need. That was very interesting.